Hello and welcome to this podcast about the December 2019 meeting of the International Accounting Standard Board on the amendments of IFRS 17 project. My name is Vitalina Kobernik and I am a member of the technical staff. With me today, Darrel Scott, member of the board. At the December meeting, the board finalized some of the amendments to IFRS 17 that were proposed in the exposure draft we published earlier this year. Darrel, at the beginning of the meeting, the board managed to finalize 6 of the proposals in around 10 minutes. Can you explain why the board was able to reach so many decisions so quickly?
Yeah, I think that's a little bit of a record for us. So it was something quite nice to have accomplished and a nice, easy introduction into the redeliberations process. I think there were a couple of drivers for that. I think the first thing to bear in mind is that these were 6 topics in which the board had received substantial support for the proposals that were in the exposure draft. And that obviously makes it a lot easier for us because we know then that our constituents agree with the approach that we had taken. But I think there was an additional factor on these ones too, which was that in setting out the plan for the next couple of months, the staff in November had already warned us that these 6 topics would be coming back and asked us whether we were comfortable that we'd be simply confirming the proposals. And I think we already had the chance in November to have a little bit of a discussion on the topics. So I think probably those 2 factors together made this a nice, easy start to the process.
Thank you, Darrel. The board also discussed the feedback on the proposed amendments for insurance acquisition cash flows and for the accounting for reinsurance contracts held. Overall, for the expected recovery of insurance acquisition cash flows topic, the board also confirmed the proposals in the exposure draft, with some clarifications on the systematic and rational allocation method of insurance acquisition cash flows. Darrel, what can you tell us about this lively discussion?
Well, this was certainly a more interesting discussion, and I think it was a more interesting discussion because in part the feedback that we got from our constituents was more mixed in terms of this proposal. So I guess a little bit of a reminder on what the ED actually proposed. It was a very specific proposal that acquisition costs that are directly attributable to a group of contracts be allocated to that group and to future groups that include subsequent renewals of those contracts. This reflects the economics, as expressed to us by many of our constituents, that acquisition costs are typically incurred bearing in mind the expectation of future renewals. And is in fact an extension of something that is already in IFRS 17. When you allocate acquisition costs to portfolios, you're already required to consider within the portfolios which specific groups those would relate to, and consequently you do it in the same approach. The wording systematic and rational is also a part of our existing IFRS 17 requirements, and hence the little bit of a discussion we had. The other thing that the ED proposed, and this was perhaps one where there was a little bit more discussion, is what we would call a dual impairment test. Firstly, an entity is required to test the acquisition costs against all contracts that are coming into a future group, so call it a high-level test. And then secondly, an entity is required to test just the renewal acquisition costs against the cash flows of future renewal contracts. And so the board discussed both of these topics. As you mentioned, the words systematic and rational were subject to some discussion at the board meeting, and a view was taken to at least provide some changes to the text as it stands at the moment in the standard. But the board agreed not to provide additional guidance, and we felt that that was because systematic and rational is intended to be a judgment that an entity must apply depending on facts and circumstances. And any additional guidance we provide in this circumstance firstly restricts the ability to apply that judgment, and secondly, perhaps just as importantly, has potentially unintended consequences on when systematic and rational is used in other places in the standard. On the dual impairment test, we also decided to confirm the dual impairment test as in place as it is at the moment. I think we took solace from the fact that the paper, through an example, indicated to us that these 2 tests actually do provide different outcomes under different circumstances, and consequently they both have validity from a mathematical perspective, if you like, from an outcomes perspective, but also because we had heard from users of IFRS 17, from investors and others, that there is information value in the outcome of both of these tests.
For the recovery of losses on reinsurance contracts held, the board decided to extend the scope of the amendment proposed in the exposure draft to apply it to all reinsurance contracts held in response to the comments received on the exposure draft. As a consequence of this scope extension, the board decided to amend the loss recovery calculation by replacing the fixed contractual percentage of claims on the underlying insurance contracts with the percentage of claims that an entity expects to recover from reinsurance contracts. Darrel, what can you tell us about the board's decision to address respondents' feedback?
I think this is the first circumstance or the first discussion we've had where the board has now concluded to make a change to the proposals in the exposure draft. And I think the board generally discussed the fact that this was actually quite a significant change to the proposals. Again, a reminder of what was in the exposure draft. We proposed that for circumstances in which a contract at initial recognition was onerous, but was covered by a pre-existing reinsurance contract, we would require an offsetting entry reflecting the profit or the recovery from the reinsurance contract to offset the loss recognized on the onerous contract. But in the ED, we proposed this only for a very narrow range of contracts. And as you mentioned, the staff proposal here was to broaden it not just to a bigger group of reinsurance contracts, but in fact to all reinsurance contract types. And so the board discussed at length, I think, why we felt that such a extensive or such a significant change was warranted. And I think it sort of played out from two different angles. The one angle to think about it was that the original proposal was very narrow, and the feedback that we received from constituents indicated that it actually applied to very few reinsurance contracts. In thinking about that, the board realized that the only way that we could then expand it beyond that was to move beyond the contractual terms to the expected outcomes. And once we moved to expected outcomes, essentially what that meant is there was no reason for the differential between some reinsurance contracts and others. Clearly under IFRS 17, which is an expected cash flow model, there are legitimate expectations for all of these different outcomes. I think it's worth noting, and it was noted at the board table by I think two different board members, that we were helped in this process by the fact that the constituent letters we received were very constructive, very helpful in proposing different alternatives to think about this, and also helped us cover the bridge that there was not going to be any additional information required in order to do this test, and that the test itself would not be an arbitrary test. There was a very specific mechanism that was proposed, and as you mentioned, that we used.
Darrel, there were many questions about the definition of proportional reinsurance contract from respondents. Can you please clarify whether this definition is still relevant?
It's a very good question. So the ED, as part of the proposal, proposed that we apply, as I mentioned earlier, to a very narrow scope of reinsurance contracts. And in order to define that narrow scope, we defined the term proportionate reinsurance. That definition was intended to apply very specifically in this specific circumstance. And now that we've made a tentative decision from the board perspective to move away from this narrow scope, the definition in of itself becomes redundant. So that definition would be scrapped in the eventual proposals that we make, or the eventual standard that we finalize.
Thank you, Darrel. I think that addresses many users' concerns. In terms of the next steps following this January board meeting, could you please tell us what are these next steps?
Sure. So this was the first meeting that actually discussed was a substantive redeliberation discussion of the topics that had been fed back to us. At the next two meetings, January and February, we will cover off on the rest of the topics that have been raised, where the staff have recommended that we go back and discuss specifics on that. Now, I think those other topics essentially fall into two groups. They are commentary that was received on proposals that we made in the ED, where people either feel that we didn't go far enough or feel that we should have changed direction slightly in where we landed. And then also a number of topics that were raised where we didn't make proposals in the exposure draft. And those are clearly topics where either we covered in detail in the basis to the exposure draft information that provided our constituents with the opportunity to respond to us, or alternatively new topics that we hadn't considered at all in the process. So those topics are likely to come back in January and February. The board also has largely acknowledged the fact that staff have recommended that on the effective date, which is one of these topics that we need to discuss, that we hold back that particular conversation until we get toward the end of the redeliberations process. And that's because the board thinks that it would be useful for us to have an oversight of the entire proposal package that we're suggesting before we actually decide what the effective date should be.
Thank you. That's an important clarification on effective date. Darrel, thanks again for this summary of the IFRS 17 discussion at the December 2019 meeting. This is our last podcast in 2019 year, and we wish you a happy holiday season. Thank you for listening.
Thank you.